Okay, great. Hi, everybody. I'm Mark Burridge. I'm a managing partner and a fund manager at Baker Steel Capital Managers. We specialize in metals and mining equities investments, covering the precious metals and future space. Got any questions? Meeting? Stand IP concept. So carry on with the presentation. Some disclaimers, so you know the usual disclaimers. I'm going to talk about a little bit introduction about us as a firm and the team, and talk about key themes for metals and mining this year, about the critical metals we need to reach net zero, some case studies on copper, silver, and gold, and then I'll talk a bit about our investment process. So let's kick off with that. So Baker Steel Capital Managers, we've been around for over 20 years. We were born out of the team that has become the BlackRock Natural Resources team. We have about $1.2 billion under management in the metals and mining equity space. We're regulated in the UK, Luxembourg-based UCITS funds, but we have offices in London and Sydney, Australia. We're quite well recognised amongst the mining for our presence in the space. We're owner-operated, performance-oriented, and independent firm specialising in the sector. We run 3 strategies, but for the purposes of today's presentation, I'm just going to talk about 2 of them. And we have the precious metal strategies and the electrum strategies. Now, the precious metal strategies are exactly what it says. It means gold, silver, and platinum group metals. Predominantly a Luxembourg-based UCITS fund, but we also have Australian and UK fund equivalents. The electrum fund is actually all about metals and minerals required for a sustainable future. That includes, but is not limited to, things like battery metals. And again, dominated by a Luxembourg UCITS fund, but also Australian and UK domiciled funds there as well for that one. And we have a UK listed investment trust. The team. So the last time I presented at this conference was about 5 years ago, and there was only half the team. Okay, so we've been busy building this team up over the last couple of years. And that's really important, because when you're an owner-operated business, independent, to actually need to build a team, high degree of conviction about the sector in which you operate. So I think it's just a point there. We've got geologists, we've got metallurgists. I was a geologist and an engineer myself in the mining industry before I moved into finance. We've got accountants, we've got fund managers, we've got social scientists and environmental scientists. So we've got quite a broad-based team, great amount of depth and breadth of experience in the sector. And the great thing about that is that unlike many boutique firms, we have huge degree of cross-coverage and survivability amongst the investment team, which means we can continue operating even if something happens, and a great deal of different opinions about different stocks. So that's the team. I think that on the right there, just some of the awards we won for our performance. So you can see that we've run specialists in the space. It's good to have awards. So over the years we always seem to accumulate awards. Also importantly, we've accumulated some really important ESG accreditations, and I'll talk more about ESG later on in the presentation. So obviously you get the awards with performance. We don't outperform every year, but we hold our head above water most years, and some years we do really well. And we do generate relative to the sector and relative to our peer group. The really important thing to note about our outperformance, on a later slide, mention here, that we generate this outperformance without taking on risk. This is really important, because the mining sector is a sector that's really famous for trying to generate performance by taking on speculative risk. We don't. We try to manage risk as well as picking the best value stock in order to generate this performance. We'll talk about that more later on when we talk about our approach, but I thought it was important to show it here. Here's another slide that demonstrates our ability to generate performance. Everybody can show how in a good year, But how did we do in a pretty difficult year for equities, which was last year? So what you can see is up slightly above the gold fund, but you can see equities as a whole had a terrible year last year in niche equities like this. A decent performance, even though silver, where we were exposed to, were down. But what was really important about our performance last year was, again, is how we perform in a really bad year. So last year, we have our future fund, Electrum. You'd think that was invested in battery metals like lithium. Well, look, lithium was down 71%. Lithium equities were down 30%. Nickel and cobalt were down 26 and 20%. Yet our fund was only down 1.8%. And we do that through active stock selection and top-down sub-sector rotation, which I'll talk about later on. So this is really important. But what it says is when you're investing in the metals and mining space, you have to be actively managed. There's so many risks out there, so many differentials between each individual metal, that if you don't actively manage the space, then this happens, not this. So that's an important point to take from this chart. So what are the big themes for the metals and mining space? So the title was all about the transition. We're talking about the energy transition, and we're talking about the interest rate transition. Well, actually, it's not interest rate transition. It's macroeconomic and geopolitical transition is what we're really talking about here. But look, we all know about the green revolution, reaching net zero by 2050, being more sustainable in what we do. And it's not just about reaching net zero, it's about society becoming more sustainable and more equitable and more inclusive. And all of these actually, in one way, shape, form, are very relevant for the metals and mining industry. But the most important thing is that we're going to have historic high demand for many metals. New metals like lithium and old metals like copper are going to see significant demand growth as a result of the green revolution, we call it, or the new industrialization, or the transition. Also, at the same time, we're going through a macroeconomic and geopolitical sea change. We don't know when interest rate cuts will come, but they will come at some point. They can't keep going up, and that generally is supportive. But at the same time, we're facing some significant economic imbalances, geopolitical tension, unprecedented levels of debt amongst many governments. And taking all these things together, some of them are good for commodities in general, and most of them are good for precious metals like gold and silver. So this is a really important theme, not just for the energy transition metals, but also, gold and silver have a role to play in a sustainable future when you think about finances and risk. What is really, really, really interesting in terms of themes right now, and we have not seen this in the last 2 or 3 cycles in the metals and mining industry, the mining companies are really well positioned. They're undervalued on a historic and relative basis. Their margins and balance sheets are robust and strong. They are exercising extremely good capital allocation discipline. So the last 2 cycles, what was happening is the mining companies were doing acquisitions or building mines that actually were generating negative returns for shareholders. They're not doing that right now. And what we're seeing is really selective and sensible M&A creating win-win value opportunities. So the mining equities are probably the best position they've ever been in the 30 years I've been in this business to take advantage of these big themes right now. A little bit about mining company valuation, because at the end of the day, we are investors and we think about value. So a couple of simple ways to think about the value in the mining sector. First of all, if we look at, I don't have a laser on here, otherwise I could point. I do. It doesn't work on the screen. Anyway, we can see is that, look, despite having decent margins, the mining sector is trading at relatively low EV/EBITDA multiples. Now you can say, oh, there's no growth. There is growth. Look, I'm telling you that copper is going to grow, lithium's going to grow. They don't pay any dividend. Well, guess what? Record dividends are being paid by the mining sector right now. And so what we're saying is that here's a sector that gives you value, but actually isn't sacrificing growth and shareholder returns at the same time. So it's a really interesting time from value. That's simplistic. Obviously, we have much more sophisticated valuation tools that we use in-house, but this just is it. Now, the other thing which is really quite interesting is if we just look at return to previous highs. So I'm talking about return to highs of the share prices of the underlying mining equities. So we have painted a picture of a great future for metals demand growth, and hence higher metal prices. Yeah, even gold. Let's look at gold equities. 50% in nominal terms, 80% in real terms return to previous highs. And those previous highs for the equities were set at a gold price that was about $300 an ounce lower than it is today. And the qualities of the mining companies have better balance sheets now than they did back then. Then you look at battery metal equities. You know, even if there's a slowdown in EV growth or a slowdown in the route to net zero, why would battery metal equities be trading at such a discount relative to historic highs, let alone potential future highs when these demand trends set in? And even broader mining equities are trading at discounts. So really interesting point there in terms of the value. So I'm giving a lot of time on this in introduction just so you get a picture. So when I dive into the detail, you know what I'm talking about. Now, I'm going to talk about, first of all, I'm going to start talking about the energy transition and what metals are needed. Well, it's not just lithium, nickel, and cobalt for batteries. It's a whole variety of metals. Silver for solar panels, copper for all the circuitry. A distributed energy grid or an electric vehicle needs 3 or 4 as a traditional energy grid or traditional combustion engine vehicle. We need ferroalloys to make buildings stronger and lighter and less carbon intensive. Clean energy generation it requires rare earths for the magnets, for example, in wind turbines, as well as the same rare earths go into electric vehicles. So it's a whole host of metals. And what this means from an investment management perspective, we have a great opportunity, but we also have a lot of confusing, complicated things going on. So, should I buy vanadium today or should I buy uranium today? I don't know what. Yeah, but I do know what to buy. That's, I guess, my job. But it's difficult if you're not actively involved in the space, what metals are performing at different times. And then in the middle of this, you have a growing circular economy, recycling component of the business, which is an area that we also invest in and is an increasing area for many of the companies that we look at. So here we have a great theme of demand for metals, yet commodities are still lagging broader financial assets. So why, if we need all these commodities to reach net zero, are we at such a low point compared to other financial assets? Another point on the point. The thing is that how many commodities? Look, 15 trillion capex is needed in the next decade, 30 trillion the decade after. That's 45 trillion. That's 3 times as much capex China spent in the noughties when it was going through its big growth phase, when it consumed iron ore, coal, and copper, and all these minerals to generate that big economic growth. That's going. If you think about that, how much of that is going to have to flow through to raw materials? So really interesting. Now, what this translates through is these big demand forecasts for renewable energy capacity. Up by 2030, we're going to need 200% more renewable energy capacity to keep on the net zero track. That 250% more solar capacity, 200% more electric vehicles. And even if electric vehicles slow down, the trend there now, and they are going to continue. We might see some more hybrids, which also use lithium and lots of copper and things like that. So what that translates through is these big demand increases for these specialty metals. Look at, over the next few years, lithium, rare earths, nickel, but not just the new metals that nobody's heard about until we had electric vehicles, but copper, one of the oldest metals we've used in the world. Guess what? We're going to need a lot more copper. We're going to need a lot more aluminium to replace steel to make things lighter and more energy efficient. Zinc, as well, uranium for nuclear energy generation, which is going to have to become a key component of reaching net zero. So a couple of case studies here. Copper. So I've talked about industry discipline and how that's contributing to this supply-demand deficit going out. So what we have is copper demand forecasts here. What's really interesting about copper demand forecast now, unlike the previous commodity demand cycle, it's not driven by China. Actually, for the first time in a long time, we're seeing Western demand for copper, the growth rate higher than the growth rate in China, because we're all building wind farms and solar farms and distributed energy grids, and we're going to need a lot more copper for that. So what's happened is that we're seeing this, and because of ESG factors and supply side discipline on capital allocation, we're seeing a turn down in or plateauing of mine production, leading to these potentially big deficits opening up in copper over the next. And that's one of the reasons why the copper price has started to increase this year, is because it just took one mine to shut down at the end of last year, and suddenly we went from a slight surplus to material under supply situation in the copper market. And you can see here more of macro detail on micro detail on what's happening on copper supply demand. We're seeing declining production, we're seeing expanding production, new mines coming on, but really not enough to offset the declining production. So it's happening. Now there's enough copper in the ground, but we need some of it is lower grade, so it needs higher copper prices to get it out of the ground, and some of it's just going to need longer time to get out of the ground. Talk about at the same time, we can see that investing in copper equities is a much better way of taking advantage of that, not only because the copper equities have growth and dividends, but they also have a beta to the copper price. So what you can see is that pure play copper companies versus a diversified mining companies show you, beta of about 1.4, 1.5 times to the copper price. So this is where you want to be. If you have a strong outlook for copper, you want to be in the copper mining equities. And what we're seeing is that after a period of inflation for the mining companies, everybody was scared that inflation was going to go like this for the mining companies, but it hasn't. It's plateaued now, and now we're seeing potential for real margin expansion, not just in copper companies. We see the same chart in gold, which we'll see later on. So I'm going to go on to the next metal, because silver, nobody thinks about silver in context of the green energy or net zero, but it's really important because solar is probably one of the best ways to generate renewable energy, but you need silver in those solar panels. And what that means, as a result of that, we've been in a deficit, supply-demand deficit of silver for a couple of years now, and we're projecting a growing supply-demand deficit over the next few years because of that. The other main factor on silver is it also behaves as a precious metal or a financial real asset. So as you can see, there's a bit of a catch-up trade that silver has to do with gold as well. So silver's really interesting right now. Not only do you really need silver in electric cars and solar panels, but you also need, but silver has potential to catch up to its historical relationship with gold. Talking about gold, gold is also looking really positive. Gold price set a new record recently. It's clearly entering into a new higher trading range. And for the first time, it hasn't been driven by rate cuts in the US. It's been driven by fundamental buying demand from retail investors in the US buying gold from Walmart on the one hand, and Chinese investors, central banks and emerging market central banks buying on the other hand. So even though ETC, exchange-traded gold, has fallen off, we've seen a pickup in gold demand and gold prices. What that means is that sets a really good platform for gold to move up to another level if and when a rate cut cycle starts again. And typically, historically, that rate cut cycle has been driving significant performance of gold. So very positive on gold as well. Same story for gold miners. Costs did rise, but they've now plateaued, so we're seeing margin expansion. We're seeing good discipline amongst the mining companies. There's been a lot of questions, gold mining companies have become underrated relative to gold. Well, we're just starting to see that turn around now, because in the previous gold recovery cycles, we've seen the gold equities outperform gold quite significantly. And this year, in the last year, we've actually seen a little signs of that's going to happen now again. So what we're hoping is that we'll start to see that trend of gold mining equities really recover to where they deserve to be, given the strong financial shape that they're in. So that's about the metals. Investment process, I've talked about. We look for undervalued stocks, but established companies. We manage risk. Stock selection has to be agile and nimble. Tactical rotation between geographies and commodities is important for us. Shareholder returns, i.e. dividends and buybacks, is important to us. Exploration development is really important, but it doesn't mean we buy small cap, micro cap exploration companies. We look for established mid-cap and large-cap companies that have got good exploration and development pipelines. M&A is creating real value in the sector right now. ESG critical, and engagement. We meet with our companies 12 times a year. We go and visit the mine sites, kick the tires at industrial plants, etc. So 3 pillars to our valuation approach: value, risk, and ESG. We have our own internal tools we use for measuring value. We have GenVal system measuring NAV. We have margin and ratio analysis. Fundamental beta, how fundamentally related a stock is to a change in commodity price, not just what the market's telling us. Shareholder returns. We run a relatively concentrated portfolio. Risk is really important. We maintain a really high degree of portfolio liquidity, which means that our funds are very scalable. There's really no portfolio liquidity risk. We manage asset and geography risk really carefully. I can talk about that later for this time. We obviously look at companies' balance sheets and corporate risk as well. Typically, we have relative concentrated portfolio of 30 to 40 positions, but we don't take big bets on any one company. Typical company weighting is 2 to 5% of the portfolio. ESG is really important in that process. We are probably the leaders in ESG in the mining space. We have Article 8 plus funds where we incorporate sustainability. We have a Lux Flag ESG rating with signatures of the UNPRI. We measure about 55 different ESG metrics where we're making our investment decisions around companies. And that help us decide if a company can make it into the portfolio and the weighting that the company should be at. So that's about the ESG. And what we can see is thanks to investors like us putting pressure on the companies to do better on ESG, actually we're seeing changes in things like safety, positive changes in things like diversity. So actually the mining industry is really working very hard to make positive changes right now. And I think that's really important because it's got to go hand in hand with mining becoming actually something that's good for the planet rather than seen as bad for the planet. And that process is happening right now. A little bit more about investment process. So we have our bottom-up stock selection tools. That includes ESG, value, and risk screens. But we also, in managing the portfolio, we do have a look from a top-down basis. So we do, in the Electrum fund in particular, we tactically rotate between different individual metals or different classes of metals. So battery metals might be having a good year one year, a bad year another year. So we might rotate, to and from precious metals depending on what's happening. So that's really quite important for us, is that tactical rotation. And this is just an example of how we've done some of that tactical rotation from year to year. I won't go through the details. What you can see is that some years precious metals we add, some years we take it away, some year we add battery metals, some years we take it away, some years we add copper, some years we take it away. That's broadly speaking part of the tactical rotation. And that's why from that very initial chart that I showed, we managed to underperform only very slightly despite a bad year for some of the metals in our portfolio. Here's another chart that just shows some of that rotation that we've done on a more sort of shorter term basis. But what that means is, coming back to portfolio performance, is that most people think that to make money in the mining sector, you can only do that by moving up the risk curve, risk going this way, right? So basically, so if you're going to get more returns, you've got to take more. Actually, no. If you manage risk and do smart stock selection and actively rotate between different geographies and commodities, you can generate superior returns, but without taking on more risk. And that's the whole point of our investment approach. What does that lead to? Make sure we see what time we got left. There you are. Perfect timing. It's funds that look like this. So first I'll talk about a snapshot of the Electrum fund. So what you can see here is we're broadly diversified around the world. A fairly heavy weighting in Latin America right now. It happens to be where quite a few important minerals like copper and silver and lithium happen to be. But also quite reasonable weightings in North America. Right now we're quite heavily weighted towards copper and aluminium and other industrial metals, quite low weighted towards battery metals. That comes in tactical rotation theme. I'd expect by the end of the year that might reverse. Who knows? But we actively look at that every month. We're only really invested in producing companies, no exploration stocks, no sort of early stage speculative things. Occasionally we might make an exception for a very special story, but right now we don't have one of those. And then for you can see by the companies, if you know the sector, you know these are all really reasonably well-known companies in the sector. Nothing weird or wonderful in there. You know, leading aluminium player, leading silver company, the leading uranium company, a leading copper company, and a mid-cap copper company. That's what's dominating the kind of positions that we have in this portfolio. A little bit about the precious metals portfolio. Again, quite well diversified globally. Very strong weighting to silver. In fact, both funds have quite heavy weighting to coming back to the silver chart that I showed earlier on. And again, if we look at the top stocks, silver company, gold company. This is very old. It's not that anyway. Gold company, and this has changed a lot, so that's why I was a bit surprised when I saw it up here. But yeah, basically, yeah. Anyway, mid-cap to large cap gold mining companies, basically. You know, the largest gold mining company, and you know, a silver company, and a couple of mid caps. Again, diversified. In the precious metals fund, we will have one or two development stage companies, which hence that. But otherwise, we always fully invested in the producing companies, and that's really it. So just to summarize, specialty metals equities facing unprecedented demand forecasts, and this is real. We have seen it in other commodities at other times. Precious metal equities are really undervalued relative to where precious metal prices are right now, and just ready to re-rate. The mining companies are in very healthy shape generally. There are a few that aren't, and that is one of the reasons why active management is key to picking and choosing between the different metals and the different companies to decide which has got the best risk-reward profile. And that wraps it up, and I'll open the floor for any questions. Oh yeah, here's the bit about the different funds and share classes and things. But the only thing I would say is we have lots of different share classes in lots of different currencies, so this isn't it. And if there's more to know, you can always ask Sven or take a couple of fact sheets and find out more.
Do you expect the copper market to go into a deficit? Supply deficit?
It already is in a deficit, I think. So if you roll back copper 6 months, everybody thought it was in a slight surplus. And what happened was that one mine closed down and 2 mining companies reduced their production plans for this year. And as a result of that, the forecast deficit for copper, which had been projected for 2027, got moved forward into this year. Now, it's a small deficit. It's only a 1% deficit. It's not a big deficit this year. So I think technically we're in deficit this year. And the best way that we know that copper entered into deficit was that smelting charges, which are called TCRC. So what happens is a copper mine produces something called a concentrate, and that goes to a smelter. And when those smelting charges get really low, what it means is that the world is scrambling for raw copper material. And those hit historic low points earlier on this year. So what happened is, we think that the copper market is in a slight deficit right now and projecting a really large deficit starting to open up in 3 or 4 years' time.
Yeah, you mentioned at the beginning that you are not expecting interest rates to go up further, or actually expect them to fall any time sooner or later, let's put it that way. Now, listening to you and looking at the commodity markets, they are giving us a little bit of different signs, I believe. So if you look at the positive carry of like a lot of commodity markets, let's say not only energy, but also in the area of soft commodities going forward, it's kind of a little bit a forecast as well to a certain degree of what could happen on the inflation side. So I'm wondering how you see that relationship going forward, especially after what you mentioned about what you're expecting for the commodity markets.
Yeah, no, I think what you can see is that inflation expectation is changing very rapidly. I think 3 months ago, rate cuts are going to happen by June. And now, of course, I don't think anybody thinks we're going to have a rate cut in June. But So, it is all over the place. And I think that's it creates some volatility in the commodity markets, because that's key for the carry trade, as it were, in terms of commodities. So I think for let's say very short-term, almost day-to-day movements in the commodity prices, I think that changing inflationary expectations has a critical effect. But I think but when you start looking at longer time frames, we're really starting to see that being overwritten by what's happening on fundamentals of supply and demand. There's no, if based on traditional models of how the gold market should work, there's no way gold should have hit a new record, last month, because real interest rates weren't coming down. The rate cut cycle pushed further back. The dollar was generally strongish, so there's no reason. So what you can see is that copper and gold, for example, broke out of those traditional shorter term things because of fundamental supply. In copper's case, it was because one mine, as I mentioned, some mines decreased production, and suddenly there wasn't enough copper to go around, so the copper price responded no matter what the rate outlook was. And in gold's case, it was because not just emerging market central banks led by China were buying more gold, but actually individual consumers ranging from Walmart shoppers to the Indian jewelry supply chain were just buying more gold. And so, what you can see is that, yes, I think that, and the important thing of that is what it's showing is that these commodity markets are so finely balanced, and it just takes a little shift of the demand side or the supply side. Suddenly that actually the carry trade doesn't matter anymore, because these things are going to, there's a deficit looming and these things are going to take off. And but you can see the opposite. The opposite might happen in another commodity. I mean, it happened in lithium last year, for example, where lithium prices collapsed, despite the positive medium to long-term price, and that was all driven again by supply demand. So hopefully that answers the question.
Any more questions? Yes.
I will do this the last question. Okay, cool.
A couple years ago, when this whole green energy transition started and Biden was elected and so on, everyone was very bullish on lithium. Where do you see the reasons for the underperformance that came after that? I mean, it didn't really perform that well, right?
I think it's all happened so quickly. You've got to try and put it in context, right? So what you can say is that lithium and EV demand now is much higher than anybody was predicting 5 years ago. Okay. But it's not as high as everybody was predicting 1 year ago. So that's sort of, so put it in context, we've gone much further than anybody thought we could have pre-Biden, but expectations were raised too high. So what we saw is slowing down of EV, or slower than expected EV sales in Europe, slower than expected EV sales in America. In Europe, it was more about economic reasons. In the US, it was more about actually practical reasons that people want petrol cars. So the thing is, there was a huge scramble for lithium. I've talked about supply-side discipline around capital allocation in the mining industry. Well, there was one big exception, and that was lithium. Everybody wanted to build a lithium mine. Governments, mining companies, car companies, oil and gas companies, chemical companies. Everybody wanted to get in the lithium game. So as a result, we saw a huge surge of lithium production coming on stream in Australia and Latin America. And just a slight softening in that demand forecast led to that, that sort of, first a spike in lithium prices because there wasn't enough, and then a collapse in lithium prices because there was too much. That surplus is going to be eaten away at some point in the next 12 months. And then we'll be back to, I think, a more normalized lithium prices. Now, I think lithium demand growth may start to slow now. And this is one of the things that we're watching very closely because there seems to be a shift. I wouldn't say a pivot, a shift to hybrid vehicles. So obviously they still use lithium in the battery component, but less lithium. They still use rare earths and copper and things like that. So hybrids are actually quite good for many of these transition metals, but it means typically less. It means less lithium, but probably more of all the others. So that we're watching that really carefully, because that's not just important for lithium demand, it's also important for platinum group metal demand. Because if we end up having this maybe an interim period of 5 to 10 years where hybrids actually sell more and EVs sell a little bit less, that actually is really important for platinum group metals, because they need platinum group metals in the auto catalysts of hybrid vehicles. So what that means, that might accelerate the PGM story. Instead of being a future story about the hydrogen economy and fuel cells, actually, we don't have enough palladium to go around because everybody's buying hybrids now. So that's an example of sort of that thing. So I've kind of talked a little about PGMs. What I'm saying is that, for every action, there's an equal and opposite reaction, and that's how we look at it from fund managers. So we might be a bit more cautious on lithium growth forecast, but the industry is taking action. So we've seen, Albemarle, for example, cut capex, cut jobs in order to react to the low prices. So the real question for the lithium industry, will it become more like the iron ore industry, dominated by a few big players that control prices in a band where they're going to make lots of money no matter what happens? Or is it going to become more like the nickel industry, where you have one great year, one mediocre year, and 2 terrible years, and it goes in those cycles? We don't know which way lithium's going to go right now in terms of that, but we're watching it and we'll keep on top of that.